So let's get started. So welcome to the Expat Tax Thailand webinar on understanding the new Thai tax regulations, which is exclusive for the readers of Thailand Life. So I'm Carl Turner. I'm the co-founder of Expat Tax Thailand. And the purpose of today's webinar is just to help people get a better understanding for the changes to the personal Thai income tax rules for foreign sourced income, help the Thailand Life readers answer the questions that they have. So at Expat Tax Thailand, we're here to help individuals understand their Thai tax filing obligations, understand the rules so they can make better informed decisions off the webinar. So if you do have any questions, there are multiple ways you can get in touch with us, either by email, info@expattaxthailand.com, or visit the website at the Ask a Questions page. And we also have a frequently asked questions page as well. So if you want to add any questions in the Q&As, if you coming in, we'll try and answer them live today. And if I don't manage to get around to them due to the sheer volume, I'll aim to reply to you individually. So if you're watching the recording, feel free to visit the Ask a Question section on the website. The link is in the YouTube URL, and we'll send it out by email as well to all of the viewers. Just to let you know that the webinar is being recorded, so I'll send you the recording by email over the next week. So before we get started, just a quick disclaimer: the content provided is intended for information purposes only. It doesn't constitute professional tax advice and should not be acted upon. So in our webinar today, I'll answer the common questions asked by Thailand Life readers. This will include: what are the tax rules in Thailand? We'll explain what assessable income is, what it isn't, and we'll also explain what are the requirements, who needs to file, and how do they file if they need to. Then we'll explain what a double taxation agreement is. Then we'll go on to the tax allowances and deductions, and what common reporting standards are and how will this be enforced. And then we'll go into the Q&A. So first of all, let's go into the tax changes that were announced last year. So let's recap. On the 15th of September 2023, there's a departmental order issued to overrule the previous rulings. This was published in the Royal Gazette, and it came into force on the 1st of January this year, 2024. And it's got a big impact on Thai tax residents who remit, which means transfer overseas income like pensions, investments, rental income, or salary into Thailand. So there's good news in November last year when the Revenue Department offered further clarity. And what this actually meant is, moving forward, any offshore foreign source income after the 1st of January 2024 remitted to Thailand by a Thai tax resident, which means if you're in Thailand 180 days or more, is deemed taxable in the year it's remitted. So I'll explain that in more simple terms. So the clarification showed any cash in the bank as of the 31st of December 2023 can be remitted into Thailand in the future. That's not taxable income. But if you do remit in new income that's paid out from the 1st of January onwards, then that needs to be filed and declared on a tax return if you're over the minimum limits. So who does this affect? Anyone who remains in Thailand 180 days or more in a calendar year. That's the definition of a Thai tax resident. So when's the calendar year? It's the 1st of January until the 31st of December. So what visa holders? Well, it applies to all visas like permanent resident, retirement, marriage, OX, smart, tourist visa, all of these. The only exclusion is the new LTR visa, so the long-term residency visa. That has an exclusion for foreign sourced income. I have another webinar on this if you would like more information on this specific visa. So let's go on to, we know who is a Thai tax resident now. Let's talk about the types of assets that are taxable in Thailand. Well, here's an extract from Section 40 from the Revenue Code, the Thai Revenue Code, it shows 8 categories of taxable income. So you can see on here that there is in Section 2, pensions, Section 4, investments and property sale. Section 5 is where property rental income is taken care of. And then number 8 is all other activity. So let's talk about, now we know what types of income, if they're remitted to Thailand, are assessable income. Now let's look into what isn't taxable. So the good news is it's not everything that you send or transfer to Thailand that is taxable. There are certain asset classes and types which are not assessable income. So cash in the bank, as mentioned earlier, from the 31st of December 2023, can be remitted into Thailand without any tax implication. Remittance of original capital. So if you have an investment that doesn't go up in value or a property that you sell for a loss, for example, you can remit that money into Thailand and there's no tax to pay because it's only on the capital gains on there. Inheritance is not taxable. So there are quite a few sources which are not taxable in Thailand. So remittance of income from previous tax years when you weren't a Thai tax resident, for example, money in the bank. Let's look at a few of us. Yeah, gifts and loans. They're other assets that may not be potentially taxable if remitted to Thailand. So just a quick note to say we're here to help. It's confusing for people to understand and we're here to help. So please feel free to ask a question and we'll get back to you. So who has to file a tax return? So it's not for everyone who remains in Thailand 180 days or more. The answer is no, they don't have to file a tax return just because they are a Thai tax resident. It's only for people who remit or transfer the 8 types of assets, which are assessable income. So like pension income, investment gains, property rental income, dividends, assets like this. If the amount remitted is more than 220,000 Thai baht in a calendar year for a joint married couple, or 120,000 Thai baht for an individual, then they have to submit a tax return. This doesn't mean you have a tax liability, but it does mean you have to file. So regardless if tax is paid in another jurisdiction on those assets, if they are an assessable income source, then you have to file a Thai tax return if the amount that you bring in is over those values I mentioned earlier. So 220,000 Thai baht per year for a joint married couple, 120,000 as an individual. So if you're remitting in non-taxable assets, so cash in the bank from previous tax years or inheritance, which is in cash, then you don't need to add this to your tax return. You don't have to file if that is your only source of income. It isn't required for the visa renewal that you have a tax ID and file a tax return. But some people don't have to file and they don't have to get a tax ID. So it's only if you meet the criteria to have to file. So if you do meet the criteria and you do have foreign source income or assessable income over the 220,000 for a married joint file or 120,000 for a single assessable income, then you need to file a tax return. First step is to get a tax ID number. So you can do that at your local revenue office or through a paid service to obtain one, like through Expat Tax Thailand. We have a service to help people obtain this on their behalf. Next, you would have to file a tax return for the current year if you are in Thailand more than 180 days or more. So in the current year, the last that you can file from the 1st of January 2025 for the current year, and the last date to file is the first week of April 2025. So you can either file yourself or use a paid service like Expat Tax Thailand to take the hassle away. We have a full online application process and we can guarantee all of your allowances and deductions. So let's go into double taxation agreements. So we get many questions on tax credits and double taxation agreements or DTAs. what this actually means. Let's spend 5 minutes actually explaining the basics, and we can answer some common misconceptions and misunderstandings. So what is the purpose of a double taxation agreement? So it's really just to set out the clear rules on how assets are taxed and divided between various contracting countries. It doesn't mean if there's a DTA in place, there's no further taxes needed to be paid. And it doesn't mean that you don't have to file a tax return if tax is paid in another jurisdiction, or that there's no more tax to pay. So whatever is mentioned in the double taxation agreement, it takes precedent over local domestic tax rules. So it's important that you actually look at the double taxation agreement specific for the assets that you have to work out how this is treated. So there are 61 different double taxation agreements, and Expat Tax Thailand, we've done the hard work for you. On our website, we've researched all 61 DTAs, and they are available to download from the website. So we can send the link out to you afterwards as well. This is a very detailed topic, and we have country-specific double taxation agreement webinars available for you to watch for the UK, US, Australia, and we have ones in the pipeline for Switzerland, Sweden, Israel, and we have others to follow. Feel free to check them out on YouTube or get in touch for the video links. So let's go into some of the common misconceptions. I mentioned a few earlier, but some of the common ones that we see are a DTA means that individuals are protected from being taxed in Thailand. That's not the case. Being taxed in another country on assets already exempts them from taxation in Thailand. And also another misconception is DTA in place means nothing needs to be filed or reported as taxes paid in another jurisdiction. Well, they're all not true. What is a tax credit? So with the double taxation agreement, it may allow you to use tax paid in another jurisdiction as a credit against the Thai personal income tax. So you may be entitled to a credit for non-refundable tax paid in another jurisdiction. This all depends on the DTA and the asset, but the principle, that's how it works. So let's talk through the general principle for a double taxation agreement. You need to check each double taxation agreement for the jurisdiction your assets are in. Then you need to check for exclusions or exemptions or any special rules regarding those assets. So in principle, the majority of articles show that assets remitted to Thailand, you can use the tax paid as a credit, but this is not in all cases. So there's some assets that are only taxable in Thailand and you can claim back the tax in another jurisdiction. You have to check each one. There's not a straightforward answer for this. So just because there's a DTA in place doesn't mean there's no tax or they don't have to file. It does mean you can potentially offset some or all of the Thai personal income tax with tax already paid. Again, you've got to really check the DTA. And we use the Thai personal allowances, not the overseas allowances for when you file in a Thai personal income tax return. So how will the tax credits work in principle? So if the double taxation agreement allows you to use the tax already paid as a credit in Thailand, then you'd need a tax certificate showing the tax paid in the other jurisdiction, and the credit can be submitted with the tax return. So because we have many different nationalities on the call from Thailand Life readers, and it's very broad, we'll go through a few country-specific DTA asset examples, but feel free to reach out. More information if you want something specific for your own country or where your assets are based. So let's go through some common questions that we've had in from Thailand Life readers. So let's start with US Social Security. Is this taxable in Thailand? So it's not assessable income in Thailand. It's excluded in the double taxation agreement. Next, let's go on to UK state pension. So we've got quite a lot of these questions in. Is it taxable in Thailand? Yes, if it's remitted into Thailand, it's classed as assessable income. You can use any tax paid in the UK as a credit against the tax in Thailand, but it is an assessable income. It has to be filed on the tax return if you bring in more than 220,000 as a joint married couple or 120,000 Thai baht of as an individual. Next, 401k. So how's this taxed in Thailand? Potentially you can claim back the tax in the USA and pay the Thai tax if you remit this money into Thailand. Australian superannuation. So if this is remitted to Thailand, it is assessable income. It is classed as pension income. So that needs to be filed on a Thai tax return. Property rental income. So I've left the country off this. This really depends on the country of the property and the double taxation agreement. Usually, in most cases, you can deduct any tax paid as a credit, but you have to check each double taxation agreement. If you remit the funds into Thailand, potentially it is assessable income. You really have to check the double taxation agreement. Property sale. So again, this really depends on the country where the property is based. If it's remitted into Thailand, you might be able to use any capital gains tax that's already paid in the other jurisdiction, but potentially there is capital gains on the property sale, which would be added to your income tax for that year if it's remitted to Thailand. And investment capital gains. Again, you need to check the double taxation agreement, whether you can use the capital gains tax paid elsewhere. You need to check the jurisdiction, but in principle, if the double taxation agreement allows you to use a tax credit, then you would file the Thai tax return and use any tax paid as a tax credit with the tax certificate. So again, case by case basis, feel free to send across your questions either via email or through the Ask a Question section on the website. So next, let's go on to the common allowances. So we'll get a lot of questions in from Thailand Life readers about what are the personal allowances and what are the deductions that I can take off. So here are some of the most common ones. There are many more, like charity donations, for example, but I just thought I'd highlight some of the most common ones. These are all on our website. Here's just a few to explain the concept. So everyone gets a personal allowance, 60,000 Thai baht. If you're married and your spouse has no income, regardless if they're in Thailand or not, then you can claim the spouse allowance, 60,000. Child allowance, if they are under 25 and in full-time education, you get an allowance of 30,000 baht. If the child is born after 2018, you get a higher amount, which is 60,000. Health insurance. So if you have a Thai local medical insurance, not an international insurance, but a local Thai registered medical insurance, then if the premium, you can deduct the premium as an allowance up to 25,000 Thai baht. And for life insurance, again, same principle. It's got to be a local insurance up to 100,000 Thai baht, but that also includes the health insurance. If you're 65 or older, you also get an extra 190,000 age allowance. So over 65, you do get a big uplift in the allowances in Thailand. So once you've worked out if you do have potentially tax to pay, work out the allowances that you get, then you need to start to look at the income tax brackets. So once you've taken off the allowances and deductions, then the first 150,000 Thai baht of assessable income is tax exempt. And then the next 150,000 is 5%. And that's an increase in scale all the way up to 35% over 5 million Thai baht. Now, if you'd like to go through a free tax calculation service, we can feel free to book in a 15-minute call to assess your own tax so that we can give you an estimate on the new tax changes and what your allowances look like and what the potential tax implications are for what you want to do. My colleague Jason is available for one-on-one calls to be able to help you understand your own tax situation. So we'll send out the link in the email follow-up. And if you're watching the recording, this will be in the notes section on the video. So now let's get into another question we get quite often is, how will the authorities know? And what information is actually being sent and why bother filing? That's some of the questions that we get. So I thought I'd explain what automatic exchange of information is and common reporting standards. And then we'll actually go through what actually happens with the information and what are the implications for not filing. So just to introduce common reporting standards, or CRS, it was actually started in 2016, and that was mainly OECD countries. And now there are over 120 countries signed up for this so far. Thailand signed in 2020, and September last year was the first time that they had the first exchange with other common reporting standards. So most countries that are on there, so common countries, all of the EU, Australia, UK, Singapore, Hong Kong. It's a global initiative to stop people avoiding tax liabilities, which otherwise would be due. So who's reportable under common reporting standards? So any owner or controlling person for a financial account who's a resident of Thailand that means the Thai Revenue Department will receive the information from all of the other common reporting standards for assets in those jurisdictions. So if you remain in Thailand more than 180 days or more in a calendar year as a Thai tax resident, Thailand will receive the data from all of your accounts in all the other jurisdictions signed up to common reporting standards. Now, for Americans, it's slightly different. That's under the FATCA. So FATCA was set up in 2014, and it was really established to avoid withholding taxes and maintain banking relationships in the US. So under FATCA, the information isn't relayed to Thailand, but Thailand actually relays all the information back to the US. So what accounts are in scope of common reporting standards? So if you have bank accounts, debit cards or credit cards, if you've got custodian arrangements like pensions, investment accounts or platforms, or insurance-based investment products, that means that the information is being already relayed to Thailand from those jurisdictions if you're a Thai tax resident. Now, what are they actually sending? So they send the name, address, tax ID, the account value, and the ins and outs for that quarter. So how does it work? Well, in principle, the Thai Revenue Department software plugs into the other common reporting standard Revenue Department software. The information is automatically downloaded and exchanged. And this also includes things like ATM and credit card usage for non-US assets of common reporting standard countries. And the information sent to the Revenue Department actually forwarded onto the Thai Revenue Department. So what are the implications of not filing a Thai tax return if you do have to file one and not paying the Thai taxes? Well, the penalties are quite harsh. The Revenue Department has full transparency on many accounts now with common reporting standards. So let's talk through the implications. So the penalty for failing to file a tax return is up to 200% of the assessed amount of tax that's payable, plus a surcharge of 1.5% for each month that the tax was owed. Then there are penalties on top for avoiding or evading payment, which can be imprisonment up to 1 year and up to a 200,000 baht fine on top. So how is this actually administered and who's the burden of proof on? It's another question that we've had quite a lot from Thailand Life readers. It's up to the individual taxpayer to self-declare on their personal income tax. No one will be in touch to tell you you have to file. It's a legal requirement if you remain more than 180 days or more and you have income levels over the the amounts listed earlier. So the 120,000 as an individual or 220,000 type R as a joint married filing couple. You need to file a tax return if you do have this by the end of March, but actually online, you can do it in the first week of April for the previous tax year. So what are the issues with self-declaration? I mean, it can be audited. So it's really important that you keep very good records of transfers into Thailand, even if they are not assessable income. So let's go on to things that we can help with. We have many useful guides. We've got a guide to actually help you understand the rules and how to actually file a tax return yourself with an easy steps and advice to give you all of the information. It's free to download on our website. If you'd like, as mentioned earlier, to have a free tax calculator session to estimate how much the new tax changes might affect you, feel free to book in a time with my colleague Jason for a 15-minute online video call to actually go through your situation. So next steps, if you'd like to ask any specific questions afterwards, feel free to send them to info@expattaxthailand.com. You can also sign up to our mailing list for regular emails and our weekly podcast. And if you'd like an individual tax consultation or advice, feel free to reach out. So on to the Q&A. So I've had quite a few questions that have come in. So let's go through some of these. Let's have a look at these. So how is investing in assets like S&P 500, ETFs and crypto if exchanges and deposits are not in and from Thailand? So I assume this means what's the tax on these assets? If they're not remitted into Thailand and they're overseas, then it's a remittance tax basis. So if you sell these assets, remit into Thailand, for S&P 500, ETFs or crypto, then you are liable for tax on the capital gains for those structures. Someone mentioned about the US-Thai tax treaty. I think we covered off a little bit on there. We actually have a US-Thai double taxation agreement webinar where there's a lot more information specific for that. Another question, how do I get a Thai tax ID number? So I answered that earlier. You can get that at the local revenue office wherever you are registered, or there's a paid service that we have where we can actually obtain that on your behalf. So you don't have to go there. So look at another question. What if I get a private loan to someone abroad and get paid back in Thailand? So it's really important if you're looking at loans that it is, is a formal loan agreement that's drawn up. It's not so simple as just having a private loan agreement. You've got to have an end date. It has to have an interest rate. It has to be a bona fide loan. It's best to get anything like this either from a bank in terms of a loan, or get this notarized and drawn up by a lawyer if you're going to go down that route, because it needs to qualify as a loan. Let's have a look at this. What about investments? Okay, yes. What about paying with offshore debit / credit cards for goods and services in Thailand? Do I need to pay tax on these transactions? So good question. So if you are using overseas credit cards to pay for assets in Thailand, that can be seen as remittance of assets. It's best to avoid doing that. If you're using an offshore, I don't know what offshore means, but a debit card, then it depends on, again, it's on the source of the funds on that debit card. If the source of the funds on the debit card is cash from previous years that can be proved, then that should be okay. But if it's assessable income, then that's remittance of assets. So we'll look at a few more. Okay, yeah. Can I clarify the rule on British state pensions again? Yeah, of course I can. So with the UK Thai double taxation agreement, There is no specific exclusion on UK state pensions. So what does that mean? It means that if you are taxed in your remit, if you remit the UK state pension into Thailand, UK has the right to tax your UK pensions. But if you remit into Thailand, also Thailand has the right to tax your pensions under domestic tax law. Because there are no exclusions in the double taxation agreement, that doesn't help you not have to declare or file a tax return. The benefit is Thailand will allow you to use the tax paid on your UK pensions as a tax credit against tax owed. So you need to work out, if you do have a state pension or other assets, you need to work out what is the gross amount and net amount that you've received. And this is the amount of tax that can potentially be deducted off your tax bill. But it's a bit of complication. If you'd like more information, please let me know. So let's have a look at some more questions. So if I would be able to transfer the majority of my assets into Thailand in a year, I am staying less than 180 days in the country. So one would simply need to stay less than 180 days in the first calendar year of one's Thai residence. Okay, so this is a question regarding bringing in assets as a non-Thai tax resident. So if you were a Thai tax resident and you remit assets into Thailand from when you were a Thai tax resident, then it's potentially taxable. If you are a non-Thai tax resident, so less than 180 days, and you disinvest assets, then that's not a tax liability in Thailand because you're a non-Thai tax resident for that year. You have to be very careful though, if you're planning to, your tax planning is to remain as a non-tax resident, because you might pick up another jurisdiction which is not as favorable as Thailand for the tax. You've got to be very careful with counting days. And it's good to sort of have a look into this. Let's have a look at this. Okay, US tax webinar. When and how can I join this? This is actually on YouTube. If you want to have a look, I will send this out as a link as well to you. So you've got that on there. Let's have a look at a few more questions. How does this apply to BOI, company owner, entrepreneur visas related to that, or no effect? So good question. So the only visa which is excluded from foreign source income because of a royal decree is the long-term residency visa, the LTR visa. Doesn't apply for the BOI visa for foreign source income. Yeah, okay. So good question here. It took me a while to read through it. You mentioned that the Thai taxation depends on the location, country of the assets, and not on the nationality passport. Can you clarify that, please? So yeah, so it's a good question. So I'm from the UK. If I have a 401k in the US and I have a Swiss pension, it doesn't really matter regarding, and I live in Thailand, it doesn't matter on my nationality. It matters on the jurisdiction where your assets are based. So it's actually, you've got to rely on, for the 401k, you've got to rely on the US Thai double taxation agreement. And for this example, for the Swiss pension, you'd need to look at the Swiss Thai double taxation agreement. That's why it doesn't really matter what passport or nationality you're holding. For the double taxation agreement, it's important what the jurisdiction is where the assets are based, if that makes sense. If income is received from my BVI registered company and then I receive it in Thailand, is such income taxable? So this is difficult with this, not much information on there. If you are a Thai tax resident and you live in Thailand and you're receiving an income from an overseas company and you have that income paid into Thailand, then the income that you receive, yes, is taxable in Thailand as sourced income. There's another caveat for this, which I can't see with this question, is if the work was conducted in Thailand, so it wasn't conducted overseas, and you were living in Thailand, then it doesn't matter if the money's, you've got a foreign company or you're getting paid overseas, all of the income is actually assessable income in Thailand. So for people with overseas businesses, if the work is conducted within while they're remaining in Thailand, then there could be implications not just on the income that's remitted, but on the whole amount. So one question about financial years and filing tax returns for tax paid on income in previous years that don't coincide. Yep. So how we use the tax credits is we actually look at what tax we estimate to be taken, and then we use that as a tax credit. So we actually work the calculations for the months which are not included on the tax return, and then we can reconcile that at a later date. A question on, does the LTR visa include the Thai Elite visa for retirees? So good question. The Elite visa is the same as all other visas I mentioned earlier. It is not exempt from foreign sourced income. So look at a question. Yeah. Are you located in Thailand? Yes, we are based in Ceylon. So we're based actually in Satun. We'll send across someone's asked for the direct email and phone number. I'll send that across to you after this. Another question, I turn 65 midway through the tax year, will the allowances be proportioned? Yes. So it's, yeah, you work out how many months you've been that age throughout the year. Any other questions? So can I just send money to my wife as a gift and she gives it back to me? So you've got to be really careful with gifts like this, because a gift is only a gift if there's no reservation of benefit. If there is a gift with reservation of benefit, so that means that you will benefit from this now or in the future, then this is not a gift. What does that mean? It means that there could be, it's actually remittance of your assets. You've got to be really careful with gifts as a form of tax planning because it's not as straightforward as just sending the assets. Another question, can I send money to the school for education? Do I get any allowances for this? So if you remit money from overseas into Thailand to whatever bank account, so whether that's to a car showroom or to a school or to purchase a property, it doesn't matter. If you're remitting the funds into Thailand, then that's remittance on your tax return. There's nothing specific for paying for education apart from you actually get the child allowances as well. Yep, so thanks for the questions. I hope you found that useful. Thanks for all the readers of Thailand Life. If you do have any other questions, feel free to reach out by email or through the Ask a Question section on the website. We're here to help. Thank you. Bye-bye.